Ever wonder why fund managers can't beat the S&P 500? Because they're sheep, and sheep get slaughtered. I've been in this business since '69. Most of these Harvard MBA types, they don't add up to dog shit. Give me guys that are poor, smart, and hungry, and no feelings. You win a few, you lose a few, but you keep on fighting. And if you need a friend, get a dog. It's trench warfare out there, pal.
Saturday, early afternoon, so welcome back for another weekly market recap. Quite an interesting week, should I say, because we've seen many different things happening, right? Or at least hitting the headlines and causing all different reactions in markets. Mostly, I would say knee-jerk reactions, at least in my view, right? That then we will have to evaluate them in the more medium term. But as for now, I would categorize them as knee-jerk reactions. Now, let's get rid of the economic calendar first and foremost because it wasn't really that huge. There was basically nothing as for the US in this case. A lot of Fed zombies talking on Monday, and then we got some data on crude oil stocks, but nothing that I really keep track of because I don't particularly trade crude oil, if at all. So, oil is not my market, to be quite honest with you. We got a few other data on Thursday, the usual jobless claims, as we discussed last week. If you want to keep track of the trend, as for the continuing jobless claims or the 4-week average, it could be some sort of a hint of what the labor market it's keep on doing it. Now, the Chicago Fed National Activity Index, it ticked down a bit. It came, in negative and a little bit below consensus. So again, if you put it together with the big picture, it could still be seen, in the grand scheme of things, as a sign of economic slowdown. And remember, slowdown doesn't mean crash, doesn't mean recession, just slow down, normalizing the economy after what we've seen with the stimulus, the checks, the BPI, the student loans forgiveness after the pandemic, which of course boosted a huge increase in GDP and in economic activity. All right. And now that the stimulus are basically wearing off and getting out of the system, we look at the economy and it's getting back to its normal long-term trajectory, given all the rest of the fundamentals for the US, right? So I wouldn't read a lot even into it, if not, again, an economy which is getting back to normal for the US, right? Okay. The PMI, I didn't pay attention to it because, those are global. I tend to put more attention on the ISM data because, of course, I do trade US markets. But maybe if you are involved in global markets, you could check them out as well if it gives you a good read into them. Not my case, unfortunately. And then what? For the US, I guess, well, we got new home sales, which came in positively, as I can read in here. But again, I'm not a real estate type of a trader or investor, so normally I don't pay attention to what's going on in the housing market, at least, week by week. Of course, if there is something big coming out which could impact the credit markets or the banking system, then of course you need to pay attention to it because the cascade of events could then be reflected even in other markets, namely the stock market, right? But other than that, not a lot in the economic calendar this week. Just as a recap of the week, you can look at the last 5 days. Everything is red because, of course, we had that type of a pullback in the equity market, right? There is really not a lot. We could just run through these tabs since there's a lot of time. We don't really take a look at them just to look at some curves. So here you got the 10-year and the 2-year, what was that? Um, curve, I guess, right? It's just the usual yield curve, right? The twos and the tens, which is now uninverted and it keeps on climbing to the upside. Same for the 10-year and the 3 months. lagging a little bit for now, but you can clearly see it's still dancing around the zero boundary here, but it looks like it wants to keep on inverting as well. Then what we got is, oh, we we didn't check these for a while now, the break evens. So they are now reflecting basically inflation where it is. As for the government data, we had a massive spike to the upside, getting into, Trump stepping into office and implementing tariffs. So the inflation scare due to tariffs, which basically went away particularly quickly, I must say. And now we are just trading at normal levels, even for this one. So again, if you needed other type of confirmations, the inflation it probably won't be the huge risk that everyone in the mainstream media are looking at. This could be another factor right here. And as for the risk of a crash, the credit market going higher, you can see that after that spike and the what was that? The Bank of America, the credit spread basically, as reported by the Bank of America database, they spiked to the upside and now they came back down. Kind of same as volatility, of course. If you imagine the VIX and the type of spike that we had in the VIX, all right? So that was just a little bit of an overview because I wanted to structure the video kind of different this time around. Call it, a little bit of a variation on the theme or just boredom if you want. But, I think it might be useful under another type of perspective. Now, if you remember last week's video, we had, of course, our analysis and our expectations or slash biases for the week to come. And as usual, right, there are things you get right, there are things you get wrong. It's almost impossible to get it right 100% of the times and get all the things right. Okay, so there's always be something that you're gonna take wrong. It's just the nature of it. But there was something interesting this week. So first of all, let's revisit real quick what was the assessment last week, and then we'll just have a look at the entirety of the markets that we usually follow, just to see what was the movement or the price action into them. All right. So the most interesting thing right now would be what's next. So can we see the dollar now? I mean, the DXY, not really the dollar, but the DXY holding this level and keep on grinding to the upside? Or is this the time where we see a rejection? Quite honestly, I don't truly believe in a rejection. My expectations, at least at the current moment in time, would be a bit more of a choppy action and another push to the upside. Okay, so a little bit of a trap fractal maybe for now. So it depends on what type of fractal do you think is the most prominent. Uh, by looking at it at first glance, I'd say there is maybe more liquidity in this one rather than this one. So could it be we got a little bit more of a push deeper into this one? So we just tapped into the shelf top. Would you see a run down to at least the shelf middle, kind of like in this pocket right here, or maybe around this point of release right here? Because I do like it. It's kind of a dodgy before the release, so maybe around here. And again, we, at least for now, we just confirmed that we want to stay in this range. So what's next? Well, up until it works, it works. So, the range is the range until the range is the range. So I'd say a little bit more of a choppiness. It was trading in between the highs and these lows. So these dealing range right here. Now, it looks like we violated it. And probably we might see a bit more of a push to the downside over the coming days, if not weeks. My point of invalidation for the current, momentum of the market. But same as we did in here, nothing says that you could just do the same. We keep on going sideways for a bit, a little bit of test, and then we jump toward 115, 120, right? So actually, these would be a much more likely scenario up until the point these regions right here can actually hold. What we've seen is 1, 2, 3, 4, 5, 6, 7. So again, 7 days of advances. We discussed last week it was 9, and 9 was kind of a historical type of amount of advances on a daily basis for the market. So it might be a little bit of a natural type of ebbs and flows. It can only go up so much before having to cool off a bit and potentially pull back. But could also be that we are now getting into another potential pocket of resistance at this level. But nonetheless, the stock market performed particularly well this week. And you just look at the weekly candle, right? So we are getting back into the top, which was put in early in 2025. So we'll see how it plays out. This is just me with the data that I'm looking at right now. And of course, as usual, this is not a static concept. This is not a static word. It's constantly changing. It's evolving. So the flow of information is always there for you to look at. So even if you have a base case, always be ready for the opposite scenario. Okay, so now that we kind of got back a little bit to see what was right, what was wrong, let's have a look at what you could try to do in order to assess, information's coming in real time. Okay, and I'm gonna take a screenshot of a conversation that I had. Let me check if it was the 19th, yeah, on Monday. Okay, so this was the conversation right here. Now, as you can see, Monday around lunchtime here where I do live. So 2 p.m. here would be basically kind of 8 a.m. in New York, probably even earlier than that if you live in another part of the US. But just to point out that the US markets weren't really open yet for the week. Okay, so I was just looking at the information. I was looking at the news basically, and as you can see, there was, over the weekend, the news actually came in on Friday, but it was talked about throughout all the weekend, and it was, the headline was this U.S. debt downgrade by, I guess it was Moody's, yeah, because the S&P and Fitch already did it in 2008, well, 2011 and 2023, right? So I guess it was Moody, and it was hitting the headlines, and I thought, you know what, it might be that catalyst that we need in order for the markets to pull back a bit, right? So now, of course, I just gave out a few percentages, just to get in the ballpark. Doesn't mean it has to be precise to the T, but just as a general rule of thumb or a general idea, okay? And quite frankly, I was kind of on the line, or at least on the side that the Qs, so the QQQ or the Nasdaq, if you wish, would have pulled back a bit more than ES or S&P. But overall, I was just looking for a pullback due to the news, okay? And if you just remember what we've seen, the market was overbought at the end of it. We got all those days of advances, and we were hitting the previous top put in at the beginning of the year, right? And of course, at the end of it, I guess it won't matter. In a few weeks or months, it won't matter. This downgrade of the US debt, it won't matter. Now, I'm not going to spend a lot of time talking about the downgrade, talking about all the talks which have been made about the dollar, the reserve currency status, or the deficit of the US, or the conditions or the dysfunctions of the bond market, because it would take too much. I was actually thinking of recording a separate video for it because there are so many things to be said and so many false narratives going around right now. But mostly, I guess it's just a lack of knowledge. I keep on getting back to the same page. People don't take the time to actually study how the bond market works, right? Otherwise, they would at least be more calm, more relaxed before jumping on the bandwagon of those type of narratives. But nonetheless, as for this week, it was just a general bias, of course, and I didn't really have any specific level at the time. Again, Monday morning for you in the US, lunchtime for me here in Europe. But that was funny because I was on the side that, you see, the news stream which is coming in, the more I read it, the more I can kind of feel like, okay, so the bond market now is getting to some levels of hatred. It's the most hated market that you can find around. That at a point, a trade on that, it must be due, and of course, some sort of a counter trend I was hinting at, because I was looking at the positioning on the bond market and the level of short interest on the TLT. All right, it doesn't mean that it has to come sooner rather than later. It's just you see it coming, you see it on the horizon, and you kind of start to sniff a bit of an opportunity here and there, but that doesn't really give you a trigger. All right, but at the end of it, again, it was just Monday back then, so I was waiting for the US market to open up and to react to it. And again, as for the bond market, I was on the side that, at the end of it, the downgrade, it changes basically nothing for how the bond market actually works and the dynamics into it. And, again, the positioning is so out of balance that at a point, some sort of a mean reversion, some sort of a bounce, a counter trend move, it's going to come. All right. But this was, at the end of it, the assessment. Beside checking and looking for a pullback in equities, I wanted to monitor the VIX today, therefore Monday, and tomorrow, therefore Tuesday, and kind of see if everything should have moved together. So basically, the VIX spiking up a little bit, right? A tiny spike in the VIX, while equities, a little bit of a typo, okay, while equities were pulling back. And gold, again, if you remember the recap from last week, instead of testing lower at this point, should have bounced with equities pulling back. It's a little bit of a risk-off scenario, okay? Now, it's not mentioned here, but these 3 or 4 things alone, they go invalidating a lot of things that, of course, would happen in currencies. So, first of all, of course, the DXY that we were kind of neutral slash maybe a bit more bullish oriented for another type of a bounce, it was shattered down. Now again, it wasn't really a crash, but nonetheless we rejected this area right here after the bounce and we kept on grinding to the downside. So at this point, we might see a retest of the lows put in at the end of April. It looks likely. And then we'll see if we can hold the region around these lows or if the DXY has more downside to come, right? But it's natural that something like that should be immediately reassessed after you come up with that type of news and you start to think about a pullback in equities, a bounce in gold. Because of course, gold it trades against the dollar, so a weaker dollar should, but well, for gold to go to the upside. But I'm not a firm believer in that inverse correlation at all costs. And as you've seen, for a good chunk of 2020, what was that? 2022, 2021? Yeah, 2021, 2022, we have seen the DXY and gold running to the upside together. But for me, it was more of if you see a little bit of a short-term sell-off pullback in equities, what I'm expecting, since a lot of people which are investing in the US market are foreigners. If you see a pullback, that means that there are going to be more more sellers than buyers. What happens if you sell off the equity market in the US, which is denominated in what? US dollars. But if you're a foreigners, once you get back into cash and you bring that cash back into your own denomination, so it could be euros if you live in Europe, it could be Chinese yuan if you live in China, it could be Japanese yen if you live in Japan. But if you sell stocks, you got what? Dollars. Then with the dollars, if you want to bring the profits home, you need to swap them back for your own currency. So therefore, a little bit of a weakness in the DXY should be kind of put on the bingo card, so to speak, and which is basically the same, which invalidated the thesis of on the euro. Right, so we were looking at the euro to test a bit deeper into the shelf. Instead, what happened is that the euro actually pointed north, same as the pound. And if you remember, we were looking, it was what, maybe 3 weeks ago, we were saying throughout all these run up in foreign currencies, we have been seeing the euro being relatively stronger compared to the pound because the euro was able to take these highs and the pound, it wasn't yet. But we said probably going to get there in time, just give it time because, at the end of it, the two currencies should be relatively and closely correlated. So there you go. Here you see the pound catching up with the euro. On top of it, we might also add, as a side note, that if you're not living under a rock, you have seen President Trump basically threatening 50% tariffs on the European Union. So, it might be that at the end of it, although the DXY was coming down, the euro got the lesser appreciation out of it because, of course, we might have problems with the Donald now. And we'll see how that plays out. Okay. As for the rest, we have seen the Japanese yen coming to the upside. Now, this is related to the overall, weakness into the dollar, but also where uh, the Bank of Japan, which is again at least claiming to let go on the yield curve control and all that type of monetary interventions, so therefore letting yields free to flow. And if you let them free to flow without putting a roof over them, that should cause them to go to the upside, and therefore the interest rates differential should benefit the yen, because they need to defend the yen at that point. Otherwise, they're gonna suffer, inflation, since that they import the majority of this stuff they need: energy, raw materials, food, and whatnot. So it's again the usual tough spot for the BOJ. On one side, they need to defend the currency. On the other, they need to secure the good functioning of the JGB's market. I think at the end of it, it's a war which cannot be won, but we'll see. We might talk months, if not years, again. Dollar Canadian again. It was, we said a bit more downside, maybe, on the back of the euro, and not believing the DXY could pull back. But instead, what we got, it's basically what we were looking for 3 weeks ago. So we had that shallow pullback, around the reaccumulation, and the dollar Canadian pushing to the upside in this case. Now, again, I say the dollar Canadian, the chart is inverted just to match all the rest, but the cross is actually US dollar versus dollar Canadian. So if you see the price scale here inverted, when it goes up, of course, the normal chart, the values should go down because they should reflect the US dollar weakening against the dollar Canadian. But the effect is, at the end of it, it's still the same, right? So we got what we were anticipating 3 weeks ago, I guess, and we didn't have that farther push down before, reaccumulating. So again, then other foreign currencies, they kept on doing what they were doing. I don't think it's worth it to spend time on these ones. All right, so let's move to gold, which was another one that's standing for to the previous recap last week. We said another push down. Instead, what we got is a push to the upside. But again, it's all due to what we've seen coming in between. Basically, at least for me, it was Saturday evening and Monday morning. All right, so that's where the kind of, call it, change of heart came in as for these assets. um Now, just for the sake of completeness, let's have a look at oil, which was one of the few we got right. It stayed in the range, as you can see, right? Bitcoin actually almost retested the 100K level. It was 102K, and then it just bounced to the upside quite sharply, I must say. A bit of a weakness on Friday on the back of basically what's going on with Trump and his continuing statements. But I mean, fundamentally, would you think Bitcoin should give a fuck about what's going on in between the trade war and the tariffs? Fundamentally, no, I guess. But it's still driven by liquidity. So if there are liquidity issues somewhere else, sooner or later, if they get bad enough, they should affect Bitcoin as well. Because again, if you have a liquidity event or a cascade of liquidations at the end of it, in order to face your obligations, you're going to be forced to sell whatever you got into profits in order to raise cash. And it just so happens that Bitcoin, it's kind of the best performing asset once again. So, if things really gets badly, overall markets in general, I guess it's unlikely Bitcoin won't be affected. Does it mean it's going to crash? Does it mean it's going to have another 6 to 9 months bear market? No, but I'm just saying, expect it to take the hit. together with all the rest of the market, right? So now when it comes down instead to yields, since we were discussing the downgrade and there was also a 20 years treasury auction, which went badly, quote unquote. But again, this is another thing that I might put in the other video I will record. I'm not sure yet if I'm going to do it on a Sunday morning or maybe Monday morning, since, it's Memorial Day, the market will be closed, I won't be trading, and I'll be home alone, might have time to kill. But all I can say right now, without getting into the weeds and woods, is that was it a bad auction? It wasn't great, right? It was on the negative side, but at the same time, it wasn't the worst we've seen so far in the history of treasuries auctions in the US. And remember, the 20 years bond, it's not even a very relevant bond, right? It's not like your twos, your fives, your tens, or your 30 years bonds. So I think again the mainstream media is putting a lot of weight onto it just to sustain the bearish narrative that America is fucked, the debt is unrepayable, foreign investors will stop buying our debt, the dollar will lose reserve currency status. We are gonna default on our debt. Whatever. You know the drill with it. Now, of course, if you just check the price action, yeah, yield spiked on the back of that headline. Again, as a knee-jerk reaction for gold, bounce. DXY pulling back. Equities pulling back. So everything kind of moves together. All right. I honestly don't think that in the medium to long term this downgrade would be of any huge significance, uh, not only for yields but also for the correct functioning of the bond market in the US. It goes so much deeper than just a bad, quote unquote, bad auction. It's just too tiny and too little to say that this market is doomed just because we had a bad auction. All right. Um, I just switched from the ETFs on the bonds to the futures. So your T bond, your T note, and your T bill. You might wonder why. Well, not a lot. I mean, it's not of, at least in my view, it's not of a particular relevance, but I just find them a bit cleaner as a chart, right? And I do also think that they might move a bit sharper and a bit in anticipation compared to the TLT or the other ETFs, because I've been noticing even the time of day while they're open, it's a bit different. And of course, these being futures, they're open 24/7. So I mean, okay, with the just tiny pause in between one day and the next, the settlement and whatnot, but eh, it's a much more continuing market compared to the ETFs I was looking at. So I'll give it a go. I see if I find myself better just looking at them. And if not, I'll get back to the ETFs, right? But we have seen the bonds, especially the long end, taking the hit. The short end, not a lot. And the 10 years in this case, so your T note was just kept on ranging for the most part. But you could say the same for the T bill. As you can see from basically last week close, we were there. Most likely, it didn't really change a lot. Now, as for the bonds, what I would say is that now everyone hates them. And again, which is why I was on these type of logic and reasoning right here. Everyone hates them, so everyone is short the bonds. So at a point, it might be you got a good opportunity to, for a trade. And in this case, it would be a long trade on the long side. I don't really think people are putting or paying too much attention on what's going on. just, again, two tiny things. If you check the long end, and especially the TLT in this moment, beyond the short interest at record levels, as for the price action, that is also trading at a third standard deviation to the downside, right? So it's kind of like physics, right? At a point, a mean reversion type of move will come. And therefore, a mean reversion coming on the back of such a huge short interest, if you see a few of these shorts getting, being taken out, that should initiate a bit of a short term. I'm not talking long term, but at least a short term rally, which again would help to fuel this mean reversion move. It's just people would be forced out of the shorts. And what you do when you close a short, well, you need to buy. So again, that would add to the buying pressure for these counter trend type of a rally. Will it be, a week long, 2 weeks long, a month? We don't know. I'm just saying that I'm eyeing an opportunity here. It doesn't mean it's gonna come tomorrow or Monday or Tuesday, but I'm just keep on monitoring these because I think at a point it will come. Especially because again, nobody wants our bonds. While instead, if you check, it doesn't look to me like the demand for bonds. It's going away. And why it's not going away? Well, because as we discussed, I don't remember if it was last week or 2 weeks ago, but if you are a pension fund, if you're a bank, if you are an insurance company, if you like bonds at, let's say, 4%, you're going to like them more at 4.5% as for the yield. So again, a lot of false narratives around in my view. So let's leave it at that. I think there is a setup brewing in here. So it's just a matter of waiting for it to be triggered and to unfold, right? Now, as for the S&P or the equity market in general, we said 3 to 4% correction. And let's take this chart. It's a bit cleaner than that, I guess. From peak to trough, 3.8 on SPY and 3.75 on the Qs. So if you look at the ETFs, if you want to check the futures, I don't have it, but we could do it. Peak to trough, 395, so a little bit more. But we're just discussing decimals point here. 386. So again, in line with what we were expecting. So the week was basically starting out on Monday on the back of the news. And here again, here's what. Look, why did I say in that message? So it's black and white. It's written down. So it doesn't leave any room to interpretation. But why did I say it's only Monday? I want to see how the equity market or in general the US market reacts to it. Because we closed down on Friday on a little bit of a weakness, but we were coming off of support, first and foremost. We have discussed so much how still retail investors are buying every single dip they see. Now, is it a good strategy? Is it not? Is the retail investor dumb? I don't know. We also discussed that historically it's a strategy which is actually paying out, especially recently. So again, we have been training an entire generation of retail investors to buy every single dip. So naturally this is what they do, and therefore I'm not blindly trying to short the news, even if I do believe they could lead to XYZ type of a unfold in time. So the markets opened up and you see a sharp rally to the upside, opening up the week on Monday. All right. But then what you've seen that we took out the previous weekly high, right? And then we spent the following day, so Tuesday, drifting down. All right. Then you got what? Wednesday, again, the market was drifting down in Asia, in the London session. We got for a reversal at the New York Open. And what we got eventually was their 20 years bad auction coming in and sending the market lower. Now, it's easy to blame it on the news, right? I wouldn't have happened if it wasn't for that. That would have never happened. I mean, maybe we don't have the counterfact, but at the end of it, the narrative was already there. So, was it the 20 years auction going badly the entire reason, or was it, as said, just a catalyst for it, right? You already have it in play, so to speak, because the market was overextended, the market was overbought. We were basically tapping in a good enough resistance at this point. A correction was due. That I think the simple logic of it is that. Now, that's something which I guess many people struggle to deal with, which is basically, although you might think uh, the markets should do XYZ, they should go up, they should go down, they should go sideways. Sometimes, the timing of that, it's particularly difficult. And many different people, whether you are investing for the mid to long term, whether, like I do, you're day trading, if I had a dime for every time I was sure the market was going, kind of like it's gotta be right now. And then again, you try to short it, you go in. Remember, we're talking day trading, so you may go in with your, I don't know, 10 point type of a stop because you want to capture that scalp to the downside, and the market immediately rally. It takes you out and it keeps on rallying for another hour before actually reversing and going where you thought it should have gone, right? So the timing is always difficult because no matter the correct read you might have, the problem with markets is that they always need some sort of a catalyst. They need a reason to do this or that. They need some sort of a justification, right? Up until the point you see that, it's really hard to actually getting in and staying here. Now, of course, if you're talking position trading, if you're talking mid to long term, swing trading, week by week, okay, that's a bit of a different topic. But day trading, I think this one, it's not the the easiest market ever to be traded intraday, right? So just just pay attention, because no matter what you think, and no matter if you eventually you're going to be right, you need to allow the market to do its thing, which is why the premise was I would wait Monday, Tuesday, and see if all these things are starting to move together. One of which was, of course, the volatility. So we've seen the VIX. Monday, it was particularly stable. Then again, Tuesday was still there. And then on Wednesday, you've seen it going up, getting back above the 20 level, retesting it on Thursday, and then Friday, keep on spiking to the upside. But you see how all throughout the week, we got this market moving in lockstep, right? First, you got the headlines, then the market digested the headlines. Then again, the market was preparing, was going on a little bit of a distribution after the initial spike to the upside. And then we got the final, so to speak, nail in the coffin with this 20 years bond auction going badly, right? And of course, don't forget, on top of it, on a Friday, we got President Trump coming out announcing so far the intentions, because if I remember correctly, he just said, I'm recommending, right, 50% tariffs. So even the language and the tone needs to be taken into consideration here, right? It didn't say from, I don't know, Monday. I guess the actual date would be June the 1st. So, but it didn't say by executive order, I here declare that effective this specific date, we are going to have this and that. He said, I'm going to recommend. Now, of course, since it is a recommendation coming from him, I wouldn't just discard that. No, it's just the old man. It went crazy. Just let him talk. He doesn't mean it. I would be I would be careful with it because so far what we've seen is that what he said, he kind of held his ground on what he was promising, and he actually delivered. Uh, Also, when he said, "It's a good time to buy stocks, right?" And just a few hours later, you got the pause on tariffs and the deal announced and whatnot. So, but again, it's kind of like Jay Powell in a sense, although there is this dualism in between the two. They are behaving kind of the same. That they are saying something and then sticking to it so far. Now, again, the political and geopolitical endgame, it's beyond simple markets, but you know, since we are in a headlines driven market right now, you need to pay attention to it, which is why I always have the financial juries tab open somewhere on my screens to see what's going on and to assess whether a move is real, is fake, it's driven by something. Could be fundamentals, it could be news, could be whatever, but you need to pay attention to this, right? So what else? As for the equity market, we got back, and let's clear this up a little bit, otherwise it's going to be messy, right? We got back to the 200 days moving average, and SPY actually retested to the T the 21 exponential, which is now coming up, is above the 55, both are upward sloped. So, is it a good bounce to buy? Maybe. I mean, at the end of it, even if you look at the levels, it would be just, support, resistance, breakthrough resistance, retest of resistance broken. So now needs to be confirmed as support. Would be textbook, right? You buy in here and then you aim at what? All-time highs, or at least, even if you're not so giga bullish, you aim at another top at the upper side of the range, right in here. So it could be a valid setup. I'm not, I'm at least so far, I'm not particularly concerned, right? Because again, the premise is that we needed to work off a bit of overbought condition. So up until the point we don't start to crack any relevant level or any particular moving average on a daily pace, I wouldn't be particularly concerned about, these market becoming a bear market rally and then having a huge downside potential. So I guess the best um, scenario, if you want to be a bull right here, is that these market to keep on hovering around this region. Let's say it is also a short week next week because of Memorial Day. So let's put it this way, right? Since we at least we need to make some sort of a prediction or come up with a little bit of a bias. I would say the short answer is neutral, slightly bullish. Okay, for all of what we have discussed so far, I I don't think we break through, especially these moving averages and these levels below, like a knife cutting through butter. All right, I think we are gonna have a little bit of a choppiness. Maybe I don't know. It could be 2 days, 3 days, maybe. Considering next week it's gonna be only 4 days of trading, maybe it could be all next week. All right, but I think eventually this market will reaccumulate here and try for another push to the upside overall. Okay, do I think we're gonna break two new highs? Because let's face it, after these resistance is taken out, you have the clear path to new all-time highs, right? So do I think we are gonna see that from here? um I keep on saying that getting into June, the middle of June, we are gonna exit the corporate buybacks window. So we are going to have a huge buyer subtracted by the books. So I guess we are kind of like, we're running on the clock, right? If we cannot do it in the next 2 weeks, I kind of doubt we are going to be able to do that throughout the summer, because then you need to factor back in seasonality. And we know June is kind of a neutral type of month, but then the more you get into the summer, the more you have months like I don't know, July, especially September, which tends to be a bit more on the bearish side. So uh, for me, the best scenario it's trying to bounce off of here and then going sideways a little bit. All right. And it wouldn't be uncommon. Okay. We have seen it happening even after the 2020 dump throughout the recovery phase. Now, if you remember, we were discussing the possibilities of a V shape or just a market which is going to be a bit more kind of subdued in its upside tone, but eventually it will try to go to the upside. So I would say a tiny bit of a consolidation in this range. Let's call it so in between the moving averages to the downside and these basically old apex right here, right? It could spikes. You could see spikes into it. Yeah, maybe okay. But if the scenario will be confirmed to be a tiny bit of a choppiness in this range, then I I think it's not bad for the Bulls, right? Of course, if you look at the other side of the equation for the Bears, what you want to see, it would be cracking immediately these support levels. And I guess the Bears really take the upper hand here if we can crash back below. On SPY would be 500 and 550. On the Qs, it would be 418. So let's try to check this out on the futures, right? So 19600 on the on NQ. Uh, at that point, I would need to change my bias a lot as for the upside, right? But for the S&P, yeah, 5,600, it's kind of the line in the sand right there. I wouldn't like to see the market cracking and closing below these lows, especially on a weekly page, because at that point you put back into discussion a lot of narratives, a lot of trends, a lot of different type of biases that you might have had on the stock market for now. So, you know, that would be my point of invalidation in order to stop being particularly bullish. So again, for now, neutral next week, but overall still slightly bullish oriented. Um, Also, again, if we want to try to run a little bit of a parallel in between what we've seen as for the bonds, so the positioning, and the stock market, so it looks like uh, the retail are buying every dip, and the institutionals are selling every rip. So again, we get back to the discussion in between smart money, dumb money. Um, if it becomes some sort of a race against not only time but also against the capital. So I guess if retail investors are gonna be tapped out, then with less buying pressure and the pressure coming from above of all those institutional short sellers, we see the market roll over. But the opposite scenario is the retail investor keeps on buying the dips, and at a point, that massive interest rate uh, on the short side, it will need to be covered. And if institutionals are forced to cover, well, I guess at that point, this market will fly, quite honestly. But again, probably it's gonna take weeks for see a bit of a resolution into it. And again, on the back of it, you should also keep on monitoring, as we did last week, the labor market data. So the situation is still particularly fluid to me throughout all these charts. But again, it's hard to be full on bearish still. So especially after this huge recovery in such a short period of time, I would keep on being a bit more on the bullish side. And again, don't discard and don't forget the fundamentals, the tariffs, the trade war, and what Trump is doing or what he's not doing. All right. So many different moving parts at the end of it. Did we forget anything? Because I do realize by the simple nature of wanting to change all the order around and focusing on one single focal point, I might have just skipped something here and there. Uh, I mean, just a little bit of a recap. What do you think about Bitcoin? I mean, it is a bull market, so sideways up, sideways up, sideways up. Again, if last week our point of invalidation for this bullish momentum was at 100K, I guess now you can move it a bit, a bit higher than that. Could it be 105K? So basically these previous resistance now broken. So up until the point we can stay above here, preliminary support, be bullish. If we crack it and we get back in between these line right here and this previous support right here, maybe get neutral. And if we crack this one right here, as for last week, then you could be a bit more bearish oriented in the short term, right? Oil, well, again, I keep on being neutral until the range is the range. And overall, from a fundamental and macro standpoint, I I don't see a lot of reasons for oil to be massively bullish. So neutral up until the point this is a range, and with a slight tint of bearishness on top of it. Okay, gold. Maybe gold deserve a little bit more of a process. I mean, as for informations, because yeah, it is true that what happened over the weekend kind of invalidated that thesis of a lower test, and we actually bounced. But let's see if we try to draw it like this. Let's see, I'll draw it out. So we are now almost at resistance. And on the other side, we got what? We got this low right here and this one right here as a trend line. So are we seeing a massive leg up? A little bit of a, I don't even remember what it is. Is it a triangle? Is it a flag? Or I guess it was a wedge, probably wedge. So could this be we got a bit of a starter step in here getting into next week, so a bit of a tiny pullback. It keeps on consolidating, and then finally we can break out and go to retest the highs. It could be. Maybe it could take even more than 1 week, but again, I guess that could be a possibility. And quite honestly, I would attribute to it a bit more odds compared to the opposite case. The opposite case, of course, at this point, same as Bitcoin, if before our point of invalidation in the very, very, very short term, right, was here, now you could bring it up here. So if you see gold basically coming back down, manifesting weakness, failing every rally, and eventually dropping below this level, now at that point, I guess, if it confirms that level to be broken and it cannot reclaim it, you can start aiming back at these lows right here. Okay. Do they have to break right away? No, but it would be a target price. If all of these happens, big if, price should naturally tend to move toward them. Slightly above it, slightly below it, and then the game starts again. Do we break it? Do we hold it? And all the rest. I think we said what we needed to say as for the DXY and the other currencies. So, well, I think there's really nothing else to say. We'll see how the VIX will behave this week. Let's try to do the same old thing. So let's do we have some sort of a trend line that could be drawn, sorry. Could draw it like this. It's not bad. I guess I mean, one, two, three. Yeah, kind of like it. But started when? It was confirmed in February. So, I mean, again, at the end of it, this is kind of like I've been saying for a long, long time now, I'm expecting 2025 to be a bit more of a much volatile market. And again, this is why I keep on saying this market, yeah, it could surprise you from one week to the next with upside moves, downside moves. And overall, though I think it's gonna end up going a bit more to the upside rather than the downside, but I still think it's gonna be a choppy mess in between. And you're gonna have many different moves all across the board, many different mean reversions because of all the headlines and the news and whatnot, the geopolitical situation. So again, the VIX for now, it's confirming that 2025 overall, it is true that at the end of it, every spike eventually cools off. But every time it cools off, it puts in a new low at a level which is a bit higher than the previous. So, yeah, again, I kind of, it's not, I don't necessarily like it or dislike it. I'm just seeing that overall the expectations that we had at the end of 2024 are being confirmed. Now, from there to say it's the best market ever, it's a whole different topic. But at least you know what type of a magnitude of moves to expect throughout the day, throughout the week, and whatever time frame you're trading. Bonds, again, I think we already said that we are expecting for a setup on the long side for a mean reversion, a counter trend rally in here overall. But there is no trigger yet, although, I guess I would say these to stick my neck out a bit. Considering we are now trading at a, especially in the long end, a third standard deviation out of the mean, away from the mean, I would say that that type of a counter trend rally, it should happen sooner rather than later. Um, you know, we need a catalyst though. We need something, I guess. We need Besson coming out and saying something about it. Or we need maybe, do you remember when we talked about the SLR requirements? Which, so all the regulatory framework around banks, which would need to, you know, seeing those SLR being loosened a bit so they would be allowed to buy more bonds. We need something like that, something which could fundamentally uh, give the green light for some huge actor to buy the bonds. Because I still think they want them. Despite the market being so weak, I don't think actually if you check the data, you can see for a fact there is still demand for bonds. And given how the system is structured, there will always be. And for all of you which are kind of rooting, because there are people which are, uh, and again, I'm not necessarily saying this against that category or that other category of traders, investors, but ironically, and not strangely, but logically enough, this is coming the most from those crypto enthusiasts and Bitcoin maximalists. Every one of them, or at least a good chunk of them that I talk to, they're all kind of rooting for these collapse in the bond market. Look, it might happen, but just be aware, careful what you wish for. The entire global economy is basically based and structured on this tiny little thing here. If this goes away, yeah, I mean, probably your Bitcoin will go up to the moon. That's fine. All kudos to you. But you're gonna wake up in a world the next morning, which is nowhere near what you remember. If you thought like, crises like 2008 or 87 were bad, you're gonna have to readjust your expectations for bad. Because if this thing blows up, nobody, nobody can describe the amount of destruction financially, economically, and therefore it's reflected in society. Uh, I'm not exaggerating, but this is the type of things which, at the end of it costs lives, right? So always be careful what you wish for, because again, you might get it, right? So okay, I guess it's enough of that. I hope these different format was a bit more appealing. Maybe not. I guess, even for the duration, it should have been even shorter relative to the recent videos, which might help. Um, I'll see if I can record the other one on, again, the bonds, the debt, the dollar, and all the rest. No guarantee, because, you know, I have a life too, sometimes. So, you know. So if you have to leave this video with just one single takeaway, make sure that the point of the video, it wasn't showing off how good I could have read the market, how quick I was in changing my ideas on a few assets here and there, just because of the news stream. All right. The point is different, because, that can happen. You can be good at it one time and miss out all the next 100 times. But that's not the point. The point is, if you check and if you remember what I said throughout all of it, that no matter my opinion, no matter what I do think fundamentally it's changing XYZ, as for the bonds, I don't think the downgrade will change anything in the medium to long run, right? The point is what John Maynard Keynes said almost 100 years ago at this point. This is not about what you think. This is about what you do think the market will think. So you might believe something, you might not believe into it. You might think it's complete garbage and stupid bullshit. The problem is, when you are engaging with these markets, whether you are investing in them, whether you're trying to time them, whether you're day trading them, always remember that the market will dictate the pace at which these markets are moving. Or should I say price is moving, otherwise it's redundant. But anyway, you got the point. Do I believe, that everything which came out from the news has a particular meaning for the stock market, for the bond market, for gold, for Bitcoin in the coming years or months? No. Did I have a different bias, a different idea while I was looking at all these things, throughout the weekend, so with market close? Yeah, I had. Uh, why did I change it? Because although I might acknowledge, or I might think that, my thesis is still valid, I also need to acknowledge that I'm not the only participant in this market. And I count shit if less than that. And the market will move as the market will move. So narratives are much more powerful in the short term than fundamentals. Fundamentals long term, they're going to take the driving seat every single time. But in the short term, could be one day, could be 1 week, could be 1 month, it could be a year, right? It doesn't matter. The market will always move on narratives more often than not, because that's what human behavior is more subject to. That's how we are wired up. Okay. So it's not about what you think, it's about what the market thinks. So if you need to change your idea, or if you need to reassess your idea, or if you need to test your idea and put it to the test, just always try to do this mental exercise. Put yourself in someone else's shoes and trying to figure, given what's going on, given the prevailing narrative, given the, even if you don't believe them, given the news, given the mainstream media, what could be the most immediate and knee-jerk reaction by a multitude, an undefined multitude of market participants before they actually and eventually come to the realization that maybe it's not like that. But in the very short term, what could it be? That's all. That was the main point. Changing something in your reasoning and in your logic and in your expectations just because you do think and you do expect that something will change in other people's expectations. And you know for a fact that those other people, they count more than you when it comes down to move price around, right? That was it. So um after that, I guess, we done it. I guess the video will come up, what, maybe an hour and 5 minutes long, so a bit shorter than the previous ones recently. I hope it helps. I'm just leaving you off now, wishing you a very good weekend, very good long weekend for you Yanks out there in the States. Hope you have fun, and we're going to be back next week. And potentially, I mean, if I can find the willingness and the force to record the other video on bonds and the dollar and whatnot, we'll see about that. Have fun, be nice, and be cool as usual. Nils out.
The point is, ladies and gentlemen, that greed, for lack of a better word, is good. Greed is right. Greed works. Greed clarifies, cuts through, and captures the essence of the evolutionary spirit. Greed in all of its forms. Greed for life, for money, for love, knowledge, has marked the upward surge of mankind, and greed, you mark my words, will not only save Teldar Paper, but that other malfunctioning corporation called the USA. Thank you very much.